Hello, my name is Kurt Worley. I am the quantitative analyst at fxbootcamp.com. Today is Friday, February 11th, 2011. This is your New York session video technical briefing. It's a video review of some of the price action we covered in the live class today at fxbootcamp.com during the New York session. And let me remind you, the purpose of FX Bootcamp is education. This is not an alert service. The currency coaches do not make trade recommendations, but we do provide real-time technical and fundamental analysis to help you put together your trade plans throughout the day. And we remind everyone that past trading performance does not predict future results. Do not trade money you cannot afford to lose. What you now see is a 4-hour chart for the US dollar index futures March contract. It's also known as the DX, as it looked at 7 a.m. New York time today on GFT's Book 360 trading platform. Now, I've got this chart zoomed out to show the price action since about January 4th, the second trading day of this relatively new year. As many of you already know, the so-called DX firmed up a bit last week following last month's sharp sell-off. Now, before I discuss more recent price action, I want to show you a Fibonacci study of that move down. I've identified the January 10th high with a blue circle on the upper left-hand portion of this chart, and the February 2nd low can be seen at about the 77 mark with another blue circle on the lower right-hand portion of this chart. Now, if I draw up a fib study based on that high and low, I learned that the 38.2% fib retracement level of that move down sits at 78.77. The 38.2% fib level represented by the horizontal bright red line on this chart. Okay, now let's zoom in on this chart and take a closer look at recent price action. I'm looking on the right-hand portion of this chart. Yesterday, the dollar recovered further. You see the move up here on the dollar yesterday, possibly due in part to renewed concerns about the sovereign debt situation in Europe. And during today's Asian and London sessions, the dollar extended yesterday's rally. You see that move in here. Now, that move reached a peak of a 78.80 right there, less than an hour ago. Now, note how close the top of that green candle is to two prospective sources of resistance. One source is the 38.2% fib of last month's dollar drop. That's again represented by the horizontal bright red line. The other source is the downward sloping green line on this chart, representing the 4-hour 200 EMA. Now, that combo could prove to be a tough nut for the dollar to crack, at least for the day, due to profit taking on recent dollar longs, especially on the last trading day of the week, or even due to a fresh group of dollar bears looking to short the USD in that area. Although looking to short the dollar does go against the recent uptrend starting on February 2nd, there was at least some technical justification for dollar bears to at least give it a shot to go short the dollar during today's New York session. Now, in terms of shorting the USD, one pair that caught my attention today was the Aussie USD. Let me show you why. This is a 15-minute chart for the Australian dollar US dollar currency pair, as that chart looked at 9 a.m. New York time today. Now, I've got this chart zoomed out to show price action since roughly 10 a.m. New York time yesterday. Although fundamentals have recently steered me towards shorting the Australian dollar, I couldn't help but notice that the recent sell-off on this pair seems to be losing steam today. Now, one of the first things I said in the live class when I looked at this chart was this: it looks like this pair wants to roll over. Now, that's worth repeating. I said that it looks like this pair wants to roll over from down to up, that is. Now, after some renewed selling pressure during today's Asian session following some dovish comments from the governor of Australia's central bank, this pair did continue to make new lows every 2 to 4 hours. I've just highlighted those series of lows with blue circles. But notice how each new low is just barely lower than the prior low. Now, that's a classic sign that the downtrend could be losing steam and could start turning up. Having said that, I don't like picking bottoms, and I'd rather not fight the recent trend if there's no good reason to do so. Before I take a counter trend long, I prefer to see multiple, I stress multiple, prospective sources of support that would justify buying in the face of recent selling. Now, looking on the lower right hand side of this chart, I see that today's low right here, identified with a blue arrow there. Today's low is at near the daily S1 pivot point. That's defined by a horizontal green line near the bottom of the chart. Now, that's all fine and good, daily S1 and a source of support, but I started wondering if there were any other source of support at or near 99.60. Just after I wrapped up my live coaching session, I took a look at a daily chart for this pair. Let me show you what I found. This is a daily chart for the Aussie as it looked at the open of today's Asian session. Now I've got this chart zoomed out to show price action since early December of last year. Now I found three prospective sources of support in addition to the daily S1 pivot point that I just mentioned earlier. Those three sources appear to have converged on that 99.60 area. The upper sloping blue line on this chart, that represents the daily 55 EMA. That's one source. The other two sources are trend lines. The orange trend line on this chart, that's based on the lows from December 1st and January 20th, both of which are circled in blue. The black trend line is based on connecting two swing lows. One swing low is circled here in red on the right-hand side of the chart. That's the February 1st low. The other low I can only show you if I zoom out further on this chart. Here it is. On the lower left-hand portion of this view, you can see the July 6th low circled in red. That's part of the basis for the black trend line. Now, I will admit, one could question how many traders can see either of those trend lines, but they do seem plausible, at least to me, and in combination with a daily 55 EMA and a daily S1 pivot point, plus the prospect of the dollar reaching a near-term top for reasons I discussed earlier, I saw, given all that, a technical case for looking along this pair of the Aussie USD during today's New York session. Okay, let's switch now to a 3-minute chart for a closer look at today's price action, which might help in the planning of a long trade entry. Here's the 3-minute chart. This view shows most of the price action you saw earlier on the 15-minute chart. Now, I'm only showing this to highlight the first major swing low formed during today's Asian session, right there at about 99.80. Okay, let's add a horizontal black line at 99.80. Now let's zoom in for a closer look at recent price action. Maybe it's just me, but it seems as if the Aussie has shown respect for that 99.80 area on multiple occasions over the past several hours. I've highlighted some examples of that with blue arrows. Now if I zoom in a little further on this chart, I can now see on the right-hand side of this view that how this pair has stalled in the 99.80 area for several minutes, actually some 15 minutes. Now that's interesting not only because the 99.80 area was support earlier today, but also for two other reasons. One is Fibonacci. If I draw a fib study of the move up from today's low down here on the lower left-hand portion of the chart, the fib study from there to the high on the upper right-hand portion of the chart right there, I learned that the 61.8% fib retracement level of that move up from today's low is represented by the horizontal blue line roughly 1 pip below 99.80. How interesting is that? Now the second reason is the clock. It's now 9:30 a.m. New York time for the opening bell on the New York Stock Exchange. Volatility in the currency market often increases after the U.S. equity market open. Now I've completely lost count of how many times I've said that in the live class at FX Bootcamp and in these video reviews. Volatility in the currency market often increases after the U.S. equity market open. There, I said it again. If this pair is going to rise further, this is the right place given today's price action, and this is the right time. If you took the shot long, you're in at or near 99.80. Again, somewhere in here, your stop loss could be positioned 50 pips below your entry for catastrophic protection purposes. And given that you're probably trading this as a counter trend scalp trade, I could not blame you if you choose to close the trade if this pair dips below the 78.6% fib, right there represented by the horizontal purple line at about 99.70. About 25 minutes later, looking on the upper right-hand portion of the chart, the Aussie is back at parity with the dollar. Now, that's a reasonable point at which to move your stop loss to break even. You're a little more than 20 pips in profit at this point. Okay, let's see how the rest of the European trading day turned out for this pair on the 15-minute chart. I saw at least three reasons to close the long trade at 1.0030, which the Aussie reached less than 1 hour before London close. London close represented by the vertical red line on the right-hand side of this chart. Today's Asian session high seen on the left-hand side of this chart, that's represented by the horizontal orange line and also indicated by the blue circle. You had the 15-minute 200 EMA, that's represented by the downward sloping green line, and the 38.2% fib retracement level of the move down from yesterday's high to today's low, that's represented represented by the horizontal bright red line at 1.0028. All three of those were within about 5 pips of the 1.0030 level at that time. Again, about an hour before London close. Again, my name is Kurt Worley, and this has been your New York session video briefing from fxbootcamp.com for Friday, February 11th.